Hey folks, I'm Clayton Collins, CEO of HW Media and your host for the Housing News Podcast. Our guest today is Tom Davis, the Chief Sales Officer of Deephaven Mortgage. Tom spends his time working very closely with wholesale and correspondent sales leaders, as well as working really closely with clients of Deephaven, which we really dig into today and understand how he and his team work directly with originators across the country. In this episode, we talk about the housing market, inventory and inflation, a brief conversation about the health of the U.S. banking system, and we don't bore you too much with talk about Silicon Valley Bank. We talk about non-QM dynamics, what Tom and the Deephaven team learned from the capital markets disruption that we saw at several points over the last 3 years, and what his institution has done to repair and improve the organization to be more successful in future environments. Tom also shares his month over month and period over period lock metrics. Listen really closely. There's some big successes happening here, and there's a lot to learn from this conversation with Tom Davis, Chief Sales Officer at Deephaven Mortgage. All right, folks, we got Tom Davis, the Chief Sales Officer at Deephaven. Tom, thanks for taking time out of this crazy week, crazy market, crazy news cycle to join us for an episode of Housing News.
Thanks for having me, Clayton. Appreciate you guys having me on today.
No worries, man. You play at such an important part of our industry right now in the non-QM segment. I'm excited to go into some of the dynamics in non-QM, but kind of want to start out talking about the housing market. We're recording this on Tuesday morning, and we just got CPI data in. I know some of our journalists have covered it. Logan Motashami's out there talking about it. We actually might be seeing a little bit of cooling inflation right now. I think the number that we wrote about this morning is that CPI rose 6% on a last 12-month basis compared to 6.4 in January. And for everyone that's an interest rate watcher, it seems like watching inflation might be one of the most important metrics out there for understanding what to expect in the 30-year fixed rate mortgage market. Is that an industry data point that you keep a close eye on, or are there other data sources that you spend more time keeping an eye on and talking to your production teams about?
Yeah, no, Dave, definitely that's one of the data points. We're always looking at, a lot of different items. For non-QM, we're looking at swap data as well. And there's just a lot of economic news coming out, especially over the weekend. Definitely have our eyes, and our capital markets team do a phenomenal job, keeping us through in this volatile market, keeping us, well positioned to take advantage of it, and keep us protected in these market environments.
Yeah, this weekend was wild. Like just watching the Silicon Valley Bank and Signature Bank news. I won't bore our audience with another podcast out there about SVB. I think there's been 500 of them published already, and by the time we hit publish on this in 36 hours, I'm sure there'll be some more news. I know there's like rhetoric happening in the industry right now that this bank shakeup, like nobody's rooting for it by any means, but it is something to watch as we think about how the Fed will interpret some of this damage that may have been imposed on the financial system, and if it influences the interest rate hikes that we can anticipate for in the next week, and then in the month after that.
Yeah, we're definitely watching it closely. I think rates have come down some. We'll see if they stay there, but I think the fundamentals of banking and mortgage banking are the same. I think these are some isolated kind of events, and for us right now, we're just heads down, business as usual. And trying to serve our clients and serve our customers, and and help them in these times.
Yeah, I think, you're right that a lot of the fundamentals are the same. I have heard some industry talk that if we see pressure on depositories, and I think depositories were positioned as being a potential big winner in 2023 and 2024, as we see so much housing wealth built up and so much equity for homeowners, that the depositories who are, maybe best positioned to help with home equity and renovation loans and lines of credit might be housing finance winners. But I feel like there might, if we have continued pressure on the depository ecosystem, this could be another year where IMBs and traditional mortgage banks might have a leg up.
Yeah, definitely. Been hearing from banks out there with they're trying to drive deposits. We're seeing some deposits leave some of the banks, and that's a big focus for them. And last year, I think the last couple of years, a lot of the banks, loaded up on, mortgage and, filled their portfolios, and some of these guys are full. So they're looking for other exits and alternative products, to add to their offering because they're limited on what they can put in their portfolio. So I think, we've seen it. And I think it's a great opportunity for, the others that are in the space to pick up share.
Yeah, we've covered, our newsroom has covered non-QM so closely over the last few years, as we just saw this massive demand from our origination audiences on any news or information related to product innovation or new products to help expand their origination suite, especially as we started to see volume start to shift in 2022. So that bridges us into a topic that I really want to get your perspective on. I have my viewpoints, but love to hear your view. Or so, what are some of the market conditions that really support a thriving non-QM market?
Right. So look, just like agency borrowers, there's non-agency borrowers in every single town in the United States, right? So, if you look 2 years, last year, the year before, when the market was a 4 trillion, 4.2, 4.3 trillion kind of market, everyone had, all this refi business, right? I think, a couple of years back in Q1 of 21, the market, 75% of the market was refinance, right? In Q1 of this year, I think it's like less than 20 or 25%. So it's kind of flip flop. So originators are having to find, alternative revenue streams and serve the underserved, market, and pay attention to borrowers that don't fit the agency box. And they're great borrowers. When you look at the loan characteristics of these borrowers, you're at a 72 LTV on average, low 30 DTIs, high 740 FICO. So good quality borrowers, well-heeled borrowers. The non-agency market serves the self-employed. We have a near record amount of self-employed folks throughout, the United States, and that trend is expected to continue. You have investors, in every town in the United States, new investors all the way to, seasoned investor, professional investors. You have credit event borrowers as well, high income borrowers, folks with assets that could qualify. So there's this group of borrowers out there that just doesn't fit the agency box, and that doesn't mean that they're not a good borrower. So we're seeing originators across the country adopt these products in a massive way over the last, let's call it 6 months. And, we're seeing a lot of our future or leading indicators of volume are showing that as well. And so, we expect the market to continue to grow in a big way.
Interesting. So I wasn't even thinking about this as I prepped for the episode, but last week I interviewed Kurt Carlton, the president and co-founder at New Western, and Kurt was talking about, so New Western, kind of primarily a marketplace for value add investment properties. So like they are seeing kind of a changing demographic in the folks that are buying investment properties through New Western, and this really big kind of wave building of Gen Z buyers who are buying investment properties pretty, early in their wealth accumulation years. And this change in, we saw so many of the iBuyers and institutional buyers sucking up a lot of the inventory and investment inventory of the last few years. And as they've kind of taken their foot off the gas, you see like the long tail of buyers coming back in. Do you see that long tail of like new investors coming into the real estate investment ecosystem, or like how do you kind of see that population growing or not?
Yeah, I think the new investors, first time investors, experienced investors, they see this market as an opportunity. In order to qualify for a cash flow program, what we require is that they ratio or cash flow, and and we want a payment of at least, let's call it, a ratio of 1. So if the payment all in is, let's call it $1,000, right? And the cash flow is over 1,000, then they could qualify and purchase an investment property. So it's the DSCR, debt service coverage ratio program, is one of the fastest growing products in the non-QM space. And even with some of the agency LLPA's recent adjustments to let's call it second homes and treating them as investment properties, that's kind of made, the non-QM DSCR programs and, more attractive as well. So some of the agency changes are pushing, those kind of investors and, second home buyers to the non-agency or non-QM space. So where we've seen an uptick over the last year in the DSCR, space.
Home price affordability and prices overall have gotten so many headlines in the last few years. And some of the like potential investment properties and rentals I've looked at, I just can't get the math to work out right now on being able to meet DSCR in some parts of the countries. Have you seen the home price appreciation as a headwind to like qualification on DSCR products, or are people finding opportunities where the math sketches out?
Yeah, there are different markets or pockets that, qualification is a little bit tighter. There's certain areas that are great opportunities. And then there's product features that can help qualify. In the non-QM space, you have ARMs, you have 40-year terms, you have interest only. So there's ways to qualify. The investor is interested in cash flow, right? Yep. So if you get a 40-year term or an IO, they're really concerned about the cash flow, depending on what their, let's call it their strategy is, whether it's if it's a fix and flip, they're going to have a different approach than someone that's going to want to hold a property for 3 to 5 years. And the folks that are holding properties for longer periods, or that's our strategy, when they go to buy these properties, they want to make sure that, it's cash flowing, right? So I would say, some of the headwinds in the investor space, definitely the, if you have home, the appreciation, actually values are coming down and then rents are coming down. Those are a couple headwinds that, investors don't really like, especially if you're in a declining market. And then, if you're doing a ratio under 1, that's something that, in tandem with those other, factors that I mentioned, investors kind of shy away from it. So we're seeing, as far as, investors wanting the product in the secondary market, they want, something that's actually cash flowing over 1, right? If you're going to invest money in something, right, wouldn't you want to invest in an asset that is positive cash flow versus negative cash flow, right? So, you're seeing some of that in the secondary market.